What's up everyone, welcome to Stockton. It's a pleasure to meet all of you. On this channel, we talk about stocks before they start blowing up, say goodbye to chasing stocks at all-time highs, and say hello to making some money. So if this sounds like something you want to take advantage of, then hit that beautiful subscribe button and like the video. Now let's get to it. Before we get into the video, I have to say that I'm not a financial advisor. Anything I say is just my opinion and is for entertainment purposes only. Having said that, if I'm talking about a company, I'll let you know whether I'm personally going to invest in it or not towards the end of the video. But you should always do your own due diligence, so with that out of the way, let's get started.
Hi guys, today I want to talk about an important development that's happened recently in the stock market that you should be aware of. Recently, ARK Invest CEO Cathie Wood discussed a valuation reset in the Chinese tech sector. Her exact words were, from a valuation point of view, these stocks have come down, and again from a valuation point of view, probably will remain down. This was of course after ARK Invest dumped most of their Tencent stock, which was around 25 million worth of stock. As things stand, Tencent now only makes up about 0.1% of their portfolio. Across all ARK Invest's ETFs, Chinese stocks now have less of a weightage than they used to before. And apparently it's not only ARK Invest that seems to be panicking when it comes to Chinese stocks. Global fund managers in July moved out of China-led emerging markets by the most of any asset class according to Bank of America's survey. We all know that China has been cracking down on its biggest tech companies like Alibaba and more recently Didi Global, which is like the Uber of China. They're trying to control these companies' growth rates because they don't want any one company to become too big and create a monopoly. And China cracking down on their own tech companies isn't the only problem here. There's also the big dark cloud hanging over these Chinese stocks that are listed in the US because of delisting fears. On Thursday, the Senate passed a bill to ban imported products from China's Xinjiang region because of allegations of forced labor practices, and the US has been adding Chinese companies to blacklist them, cutting them off from US investment. So even though it seems highly unlikely that delisting of Chinese stocks occurs, you can't ignore it as being a possibility. So there is heaps of uncertainty here. One argument that you'll hear is that, well, if Chinese stocks do get delisted, it won't really matter because you would still own the shares. Okay, that's true, you would still own the shares, but what use will that be if you're unable to sell them? We only have to go back in time when China Mobile was delisted following the executive order from Donald Trump. In this particular scenario, institutional investors were able to convert to Hong Kong listed shares, but many retail investors are still stuck in limbo. Even to this day, many investors cannot sell their shares and are being told to seek foreign brokers. So I guess now the main question is, what should you do as a retail investor if you're holding Chinese stocks? I personally invested in NIO when it was trading at around $7, so I too need to make a decision about the best strategy going forward when it comes to investing here. The fact is that if you're stuck holding individual Chinese stocks, then there is a chance that your company might get delisted if they don't comply with the rules. But don't get me wrong, I do believe that there's tremendous upside being exposed to Chinese companies just because of how quickly the country's GDP is growing. One workaround could be that you invest in mutual funds or an exchange-traded fund manager that can manage growing complexities. Another strategy would be to simply sell your Chinese stocks and invest elsewhere. However, I'm not recommending one or the other because there's still so much uncertainty here and there are more questions than answers when it comes to Chinese stocks. So what am I personally doing about the situation? Well, for me, the only Chinese company that I'm currently invested in is NIO. I don't feel like there is an imminent danger of delisting right now, because there is a 3-year window for compliance. Even though the Senate did pass a bill last month that would accelerate timeline to just 2 years, let's say we still have 2 years. So in the meanwhile, I'm just going to keep my ear to the ground and closely follow the news and make a decision when I feel like I have enough information. I personally feel that NIO will be able to comply with the rules, and I feel there's still a lot of room for growth in NIO before China starts cracking down on them because they've become too big for their own good. But as always, I'll keep you updated on what's going on and any new developments here. Anyways guys, that's it for today's video. I hope you have a great weekend and I'll see you in the next one.